Right. Yeah. So 417 is the conforming limit, 417,000. So that's what's known as the Fannie Mae Freddie Mac conforming limit. That's where you're going to get your best rates. There's also what they call an agency jumbo, and that can go up to 729, 750 in certain counties. Santa Clara is one. It gets the rates are going to still be very good. But there are adds for the loan amount. So it may be, you know, an eighth to 3/8 higher in interest rate, depending. But it's still very good rates if you can qualify for that. The income guidelines are very strict, but if you can qualify, it's great. Good interest rate.
No, it used to be you could finance like 90% of your purchase price. Now what are we looking at?
The only way to really do that now is to go with an FHA loan, and we can go up to 97.75%. Although the borrower has to have 3.5% of their own money into the purchase. So really, if you don't have a lot of down payment right now, the FHA loan is really your only option. And
that won't work very well in this area. So.
You're right. Although they will go up to 729, 750. Yeah. But you're going to be paying mortgage insurance, and the FHA they hit you two ways. You're paying an upfront premium of 1.75% of the loan amount.
Wow.
And on a $700,000 loan, that's a big chunk.
Yeah.
Plus you're paying 0.55% every month as mortgage insurance. So that's another big dollar amount when you're looking at a $700,000 loan. Yeah. But a lot of times, it's the only way you can get a loan. We're working on one right now that you would say this would be a client. It would be your grade A client. They have enough verifiable assets to pay cash for this home. It's a father helping his son buy a home. The only way we can do it is an FHA loan, and they're coming in with 30% down. They're getting a nice interest rate, but they're still paying a lot in mortgage insurance. Yeah. But it's the only way that we can get them qualified to purchase this home. So it's kind of crazy.
Okay. Now, Wymac specializes in processing no points, no fees loans. What does that mean, and why does Wymac favor those types of loans?
Yeah, we've done that. That's kind of been the peg we've hung our hat on with our CPAs that we've worked with. We really like it. I like it. And because the borrower can't really get hurt. They're not paying anything for the loan. So if rates go down, okay, good. We can refinance you again because you haven't paid anything. You haven't lost anything. So I really like it personally, especially in an environment like we're in now where we're not sure what's going to happen. Some people are saying, well, hey, rates are going to go up. Eventually they're going to have to go up, but we don't know when. Are they going to go down a little bit before they go up? We don't know. And if you're unsure, we'd say, hey, get a no point, no fee loan. If rates go down and you think you've hit bottom, pay points and fees and lock in your interest rate for 30 years. But if you're not sure, hey, this is a good way to go, and you really can't get hurt. Now, let me explain the way we're able to do this. The lenders pay us a commission or a rebate or a yield spread premium, and you'll hear these terms thrown around on the news and in Congress. And with this yield spread premium, we can pay for all the costs associated with the loan. That's the appraisal, the title, the escrow, the recording, what it costs to order the payoff from the current lender. There's all these myriad of costs that are on it when you do a loan. We can pay all of those. Whatever we have left over is our profit, and hopefully we have a lot left over, but sometimes we don't. But for the borrower, it's great because they don't have to worry. It's not costing them a thing. So yeah, we've really liked those. We've explained them to our CPAs, and most of our CPAs think they're great because client doesn't get mad at them if the rates drop. Yeah. You know, the worst thing that can happen is you finish a loan and then the rates drop and the guy's paid points and fees, and he'll say, Mike, why'd you let me do that? Yeah. Well, that's what you wanted to do. Yeah. You thought they'd hit bottom. Yeah. Well, we don't know.
Yeah. So I guess that sort of leads to the next question, and that is, when can you refinance again after setting up a new mortgage, like you just refinanced or whatever?
Yeah, well, we work with the best lenders out there that are remaining in lending, and we have preferred status with the lenders that we work with. So we don't do anything that will, is harmful to them, and they have guidelines they've set up for us. So, for example, Bank of America, they'll let us redo a loan 60 days after it closes.
Okay.
Wells Fargo, we work on the wholesale departments with both these banks. Wells Fargo, if it's a benefit to the borrower, they'll let us do it immediately, which has been a real plus to people. Rates will drop while we're going through the refinance process, and we'll say, Joe, let's do it again. It looks like rates have gone down. We can get you a quarter better. Sure, why wouldn't you want to do that? So yeah, that's a nice benefit. Mm-hmm. Other lenders that we work with, it can be up to 6 months that we have to wait.
Okay. So when let's just say when you and I are watching, what's the relationship between what's happening on the stock market and mortgage interest rates? Yeah,
and that's a good question. Traditionally mortgages have been priced to the 10-year bond. And what you'll see happening generally when the stock market is going good, like today, for example, money flows from the bond market into the stock market, and so the yield goes up on the bonds. And that's exactly what happened today. So interest rates had a couple of hits today where they went up. And that's generally what's going to happen, although it doesn't happen every time. Mm-hmm. But if you look at the 10-year bond, when yield goes up, interest rates go up. When yield goes down, interest rates will eventually go down, although it's just like gasoline prices. They go up really fast and they go down slower. But when the stock market's having a good day, typically money's flowing out of the bond market into the stock market, and so yield's going up on bonds. So you can generally draw that correlation.
Okay. We're getting close to the end of our time. Maybe you can briefly say something about what you think the future holds for the home mortgage marketplace.
Yeah, that's
got your crystal ball handy.
That's the question we always get. What's your rate today, and what's going to happen? What are rates going to be? And honestly, I don't know. If you're going to put me on the spot and make me say something, here's what I'm going to say. I think we're going to see a similar environment at least through the first quarter of next year. And we might even see rates go down a little bit more. At some point, they've got to go up. We all know that, but boy, nobody wants to be the guy that pushed the button to raise the rates. I mean, the economy's still not to a point where I think we're safe doing that. So my prediction, and it's purely my prediction, is I think we're going to see a similar environment at least through the first quarter.
Yeah, so hopefully, hopefully we'll have some stability here for at least a little while.
Yeah.
Tom, we're out of time. I want to thank you so much for coming and being my guest today.
Appreciate it, Mike. Yeah, glad I could be here.
Hopefully another time we'll get together and see what's going on in the mortgage marketplace. And so thank you for watching today on Financial Insider Weekly, and we'll see you next time.